So in this lecture, we discuss very simple, basic model of a stock valuation. So at the moment, we know how to apply the concepts of time value of money to the bond valuation. And today we try doing the same for stocks. It is relatively easy to predict the cash flows received from bonds. So we have seen an example of one particular bond of a company Whoosh, but in principle, the parameters of this bond are not changing and they are fixed. And you know that at any time until the maturity, these parameters are going to be stable. That's why it is relatively easy to know when and how much you will receive from the bond. The situation is completely opposite in the case of a common stock, because forecasting the cash flows is much more difficult. Maybe somebody can help me and explain why it is more difficult to forecast cash flows from stocks. We have discussed this in the first lecture briefly.
Because there are no guarantees that this company is not going to decrease the stock price, or not the company, the shareholders or stakeholders. Like in Tesla, when the chief executive officer makes a statement and the stock values are getting lower due to this factor. But in terms of bonds, it is more concrete. There are you know how much exactly you are going to receive.
Okay. If we are not, so suppose that we are not concerned with the current market prices. Suppose we are not doing some speculations on the market. Suppose that we are long-term investors who hold both bonds and stocks for a long period of time. And we don't care much about what chief executive officers are saying about their company. Why we still have this problem with the difficulty of the forecasting? What kind of cash flow do we receive from a common stock if we are not going to sell this stock? If I want to hold this stock for 10 years, let's say, or 15 years or 20 years, why I am doing this? What is the cash flow in this case?
It's going to be dividends.
It's going to be dividends. Why dividends are more difficult to predict?
Because it depends on the, because once again, it depends on the, for example, board of the directors, and they might decide not to provide, let's say, like they might decide to provide less amount of dividends than in previous, let's say, quarter or the previous year.
Okay, we discussed this issue when we spoke about corporate governance, that in principle, the size of dividends is set by or recommended by the board of directors. And this is one issue why it is very difficult to predict the size of dividends. Another issue, suppose that the board of directors is very nice and they very benevolent and they do care about shareholders. What is the other factor that influences the size of dividends? And which is terribly different to predict.
I also have a hypothesis that analytics who are predicting and forecasting the cash flow from dividends, they can only predict it by the current states of dividends. And
this is so you're moving away from the question. You are trying to think how to predict the dividends. No, let's go back to the core question. What is the factor that affects the size of dividends? So first of all, we know that one factor is the decision of the board, but this decision also has some conditions. So the board is not able to give you any amount of dividends. They are also constrained with something. So what is the most basic factor affecting the size of dividends?
how company is profitable, like amount
Profits.
of
Corporate
profits. It depends
profits.
on the profits.
Yes, so the size of corporate profits, because the dividend is the part of a corporate profit. And if the profits are rising, of course, a company has an ability to pay more. But if the profits are reducing, so then the company is not able to pay. If the company faces losses, the company pays no dividends. So there are two important factors, and this mostly differs stocks valuation from the bonds valuation. In the bond, everything is explicitly shown, and the company takes a liability to pay you that much in the future. In the case of common stocks, that's not an issue. It depends on two most important factors. Yeah, so that's why the stock valuation is more complicated. And then we can extend the answer of Rodion that a lot of financial analysts are working on this forecast, and they are trying to support some opinions. They believe that company will face huge profit. Some analysts are thinking that company is gonna pay moderate dividends and so on. So there are many different decisions, many different beliefs about the company future, and in this sense, of course, stock valuation is a very complicated thing. So I'm not going to tell you everything about stock valuation in this lecture. We will start moving in that direction in small steps. And of course, that's not an essence of the whole course here. So, to some extent, stock valuation is an art rather than some science and knowledge. So today we will start with a simple model that provides you a framework how you need to think about stock valuation, what you need to take into account, and why, after all, the tweets of Elon Musk affect the current stock prices of Tesla on the financial market. I hope you also will understand why this happens. By the way, Tesla faced positive profits only 2 or 3 years ago. And exactly at that time, the price of Tesla has been increasing as a rocket. So that's another question, why people are paying something for stocks of a company which is not profitable, which faces losses. Well, in the next lectures, we'll proceed to more advanced models, more advanced questions, but still, we are not going to cover everything about stock valuation. It's almost impossible. Let's start with the definition. A common stock. It represents an ownership interest in a corporation. So if you have a common stock of a company, you are an owner, or you an owner of a part of a capital within this company. And there are several rights that you obtain with the help of a stock. So first of all, it entitles you to dividends if company decides to pay dividends or if company is able to pay given profits. You can sell it at some future date. If this is a public company, and we are mostly talking about public companies, you can sell it at any time, yes. That's another source of cash flow. But again, the question is what is going to be the price? And nobody basically forces you to sell stock. So that's why if something happens to the stock price and the stock price goes down, just wait. Don't panic and don't sell it right away. Well, some terminology: if we sell a stock at the price above the purchase price, so let's say we purchase a stock at 100 rubles and sell it later at 110 rubles, this difference, 10 rubles, is gonna be a capital gain. It's gonna be called a capital gain. Regarding the rights and privileges of stockholders, so what do we have? What kind of rights and privileges do we have when we own a stock? So first of all, we are owners of a corporation, a lot of owners. And first of all, we have a right to elect the firm's directors, together with some other rights, to elect the audit committee, to vote on the dividends, to vote on some other strategic issues in the company. But mostly we are not participating in the day-to-day management of the company. So we do this through the proxies, and these proxies are board of directors. So if you don't remember this part, go to the first lecture and read this once again. And there is another right which concerns us in this topic, which is called the preemptive right, the right to purchase any additional shares sold by the firm. A particular example, maybe 1 month ago, basically, let's see, I don't remember exactly. Yeah, June 14th around. Aeroflot, Russian Airlines, they decided to issue new stocks. So do we have some news about it? Okay, doesn't matter. They decided to issue new stocks like several months ago, and they send me a message. Since I'm the owner of their stocks, they send me a message that I have a preemptive right, which means that I can purchase any amount of stocks from this new issue, kind of in the first order. So I have, oh, how to call it? So in the first place, they offer it to me, and then if I reject this offer, if I don't want to buy, then they will sell stocks uh, to any people who are interested in this. So this is a preemptive right, and this is how it works. So basically, why it happens: just if you don't want, if you as an owner don't want the property, the ownership of this company to go somewhere else, you have a right to keep your holding in this company and the fraction of this holding in the company. So let's remind ourselves about dividends, exactly what we have started with. So dividends are paid when two conditions are met. So first of all, the company has earnings or profit, must be positive. and the management, the board of directors, chooses to pay dividends. So remember corporate governance topic when we spoke that you really need to take care of the previous decisions of the board of directors and management. If they were paying, if they were deciding to pay dividends in the past, so probably they do care about the interest of shareholders and they will keep paying dividends in the future. Otherwise, if you can see that the board from time to time fails to fulfill these it's not obligations but promises, let's say, then of course it is not very nice. Yeah, there is a difference between bonds and stocks in this with this regard. So bond contains a promise to pay interest. So company promises, and basically this even we can make it even stronger. It's not a promise, it's an obligation to pay interest. So the company is obliged to pay you interest on the stock, on the bond. But in the stock, you expect to receive dividend. That's another issue. So nobody, as Rodion correctly said, nobody promises you to pay dividends. You rather expect that company will have a profit and they will decide that you will receive this dividend. And of course, your expectations may not be met, in fact. So you expect some dividends to be paid, but the company decides that this is not the correct time, or they need to keep money for some other issues. So this was the general setting. What are we talking about? What's the difference between stock and bond? How dividends are paid, and what kind of rights and privileges do we have? Any questions at this moment? Good. Now we move to the technical things, how we are implementing the stock valuation. First of all, let's introduce some notation in this topic. So we will be operating with several variables. First, dt is a dividend the stockholder expects to receive at the end of year t. So this is the part of a cash flow at the year t. There are some special dividends. D0. D0 is the historic dividend, so the most recent dividend which has already been paid. The last dividend received by stockholders of this company. This is D0. D1 is the first dividend expected at the end of the current year. So, like, assume that you purchase a stock right now. What is the size of a dividend you expect in the end of this period? D1. P0, or present value, is the actual market price of the stock today. Right? So what is the price of a stock that we face? P hat T, this is the expected stock price at the end of year T. Expected means it might be not realized. So we expect, but we don't know whether it's gonna be met or not. Small g is the expected growth rate in dividends predicted by a marginal investor. So who is the marginal investor? A marginal investor is an investor who is basically indifferent between purchasing a stock or not purchasing a stock. And from time value of money, we didn't use this term, but from time value of money, you might remember that when market price is equal to a present value, then you are indifferent between buying an asset and not buying an asset. If the market price is below present value, then you necessarily buy this asset. So a marginal investor is an investor who has present value equal to the market price. Because again, we are talking about expectations. Every single investor might have his or her own expectations, and of course they will be having different valuation of stocks. In order to have one particular measure, we will have this G as predicted by a marginal investor. RS is the minimum acceptable or required rate of return on the stock. We used RD for bonds, now it's RS for stock. Again, minimum acceptable or required rate of return. So what do we want to receive from our investments in stock? R hat S is an expected rate of return. These two things are different, so we will discuss the difference on the next slide. But this is what I want, and this is what I expect to receive. And RS bar is an actual or realized rate of return. So we can know this only after we collect some data. Maybe to see the application of these things, we can look at some particular example. Let's take a particular company. So from companies who are paying dividends more or less frequently, what comes to my mind? Fosagra, maybe Severstal also. Okay, so let's take Severstal. I'm not sure about their dividend prospects in the future, but we can try looking at this. So here is the data on the stock of Severstal traded on the Moscow exchange. What do we want to find? So we want to find what are we able to find? So we are able to find D0, dividend, the most recent dividend paid by the company. So let's try to write this down. So we are able to find out of this D0. So the last dividend paid. Let's try looking for this. So here, somewhere down there. Well, do they disclose? So here we can get the data only about their stock prices. Well, we still need this data. But regarding the dividends, we can go to the internet side of this company. So the style dividends, something like that. Well, investing, more or less nice source, but of course it is better to go to their own internet site and see what do they report here. Come on. Okay. No access to server style. Let's see. What about Fasagra? Okay, Fasagra has an access. Nice. Okay, here is a dividend history for a particular company, Fasagra. What do we see? We see that the company pays dividends quarterly, which means that it is not necessarily to be an annual cash flow, it might be also quarterly cash flow. We see that company has paid dividends in 19, 20, 21 till the third quarter of 21. And here is the data about declaration date. Here is the data about the date of record. Yeah, so the last declared dividend has been paid on the third quarter of 2021. So maybe they has changed their policy. I have no idea. So we can basically go to their dividend policy and see how oftenly they are paying dividends. The principles of company's dividend policy. The key principles, conditions. Yeah, okay, look, so they somehow disclose the information about the conditions. How do they pay dividends? The company may follow in the results of the first quarter, 6 months, 9 months, and or the whole of the financial year elect to declare dividends on the outstanding shares. So they explicitly show you that they, in principle, they can pay dividends every quarter. The resolution to pay dividends following the results of the first may be made within 3 months of the expiration of the relevant period. So the period expired, and then within 3 months they can recommend paying dividends. Conditions to the payment of dividends are as follows. The company has accumulated the relevant and distributed net profit, so profit. Dividends are not restricted as specified in section 6, so we can go to this section 6. The company's board of directors issues recommendations. That's what we have discussed with you. And the company's general shareholders meeting has adopted the resolution to pay dividends. Of course, the shareholders must accept that dividends are going to be paid. So the calculation, they actually disclose the way how do they calculate. And then restricted dividends. The company may not resolve dividends on shares, well, until full payment of company's authorized capital, not necessarily until all the shares that have to be bought in accordance with Okay, so this is not an issue in our day. On the day of such decision, the company shows signs of insolvency. Okay, of course, if the company shows the signs of insolvency, they not pay dividends. Net value of company's assets otherwise provided within the laws. May not pay the declared dividends on shares. Yeah, so basically all the conditions are here. Probably due to the economic conditions, Fasagra decided not to declare dividends in 2022, just to keep their amount. But at least from here, we can say that for, okay, so now for Sagra stock, the last paid dividend, D0, is 234 rubles per share. Okay, just to to have some diversity, we can also look at Gazprom dividends. They are paying regular dividends. Well, what's the reason? So we have investors here and we have dividends here. You see that in 2021 they paid nothing, which means, and this one is recommended by the board, but let's see all the sequence of dividends. So it was 7, 7, 8, 8, 16, 15, 12, 2021 nothing, and now they recommended to pay 51 rubles, which is basically the compensation, I guess, for 2021, right? Because if it was 12 and a half, and now they propose to pay 51.3, it means that probably they compensated from here. But again, this is recommended, and it doesn't mean that this recommendation will be approved by the shareholders. So D0 is 12.55 for Gazprom. So this is the Q3 2021. This was 12.55 rubles. This is 2020. Okay, that's the way how you can find the data on dividends of a company. What else are we able to find for the company? Actual or realized rate of return for some particular period. So let's say, well, we need to assume something in order to compute this. So assume that we purchased Osagra stock on, let's say, so if it's the third quarter of 2021, what's the date today? So it's 8th October 2019 and sold on, let's say, 8th of February 2020. Something like this. So how should we compute the realized return? How should we compute the realized return? So we need to know the price of Fosagra stock on this date, and also if there are some dividends, we also need to include those dividends there. And that's where we need the data from the stock exchange. Well, 8th of October 2019. So October 2019 is somewhere here. we basically can find the date here, 2019, 8th of October, it was Wednesday. So here we have the full explanation of this condition. So suppose that we use the closing price, so 2.525 here. This is for Saga. Yeah. So 2,525. So price on 8th October 2019 is 2,525. Let's take the closing price. Price on 8th of February 2020, right before COVID outbreak. Let's see here. So 8th of February Saturday. So let's take 7th of February Friday. Let's change 7th of February. And the price is 2,439. So you see that the price has declined. But now let's see whether we received some dividends over this time. We need to go to the dividend history of this company, and between these two dates, are we received some dividends. So here, date of record was 15th of October. So basically, what does it mean? They declared dividends on 4th of October, and date of record means that if you were able to purchase the stock before the date of record, you are entitled to this dividend. So we received the dividend for second quarter 2019, which is 54 rubles, and another dividend, we were here on the 4th of February entitled to another dividend, 48 rubles. So for the third quarter of 2019, yes. So it is 48. Again, if you were able to purchase a stock before date of record, you are entitled to this dividend. You have a right to get this dividend. Same here. You sold this stock after the record date, which means that in principle, you will also receive this dividend. So final realized return is, so this is simple, how much we received, 2,439 plus 54 plus 48 minus 2,525 that we paid and divided by 2,525 that we paid. So what is that? How much is that? 2,439 plus 54 plus 48 minus 2,525 divided by 2,525. Okay, not very profitable investment, but at least positive. So 0.63% over this period of time. So that's how we can compute the realized return on the stock. Well, maybe the time for selling was not very good, because in that time already some negative processes in the world economy appeared, right, because of COVID. But still, it's positive. So you can see that realized return is based on dividends, and it's based on the history of past prices, the purchase price, and the selling price. But if we are talking about other measures like D1, P0, P hat T, G, RS or RSS hat, those are expected things. We need to build first our expectations about the future, and then we are able to compute the things. So only two historical things are available to us: the most recent dividend and the actual or realized rate of return. Now, let us discuss the difference between these rates of the return measures. So we said that RS is the minimum acceptable or required rate of return. So what does it mean? First of all, it needs to consider riskiness and the returns available on other instruments. If the investment in a stock is risky, you require from this investment higher return, because the more risk you are taking, the more you want to get in return. Returns available on other instruments mean that if you are buying stocks of, let's say, Fosagra, there are a lot of alternatives. Instead of Fosagra, you can purchase stocks of Severstal, MTS, Yandex, any other company. And of course, you need to take into account those alternatives. If something is more profitable and has the same risk, why do you want to get less profit here? Then it relates to marginal investors. So you can, of course, take it personally. So personally, I want to use this. But usually if you want to compute something like an internal value of the stock, we need to take the minimum acceptable rate for marginal investors. And it depends on many different factors. Real rate of return, expected inflation, risk, market conditions, macroeconomic conditions, many different. R hat, which is expected rate of return. This is applicable to a single investor. So an investor who buys the stock expects to receive this return in the future. So the logic of the calculation is the same as we had here, but the only one thing needed to be changed. We know the purchase price, we know the price that we are going to pay, but we don't know what size of the dividend we are going to receive, and we don't know what is the price that we are going to receive after reselling the stock in the future. So these things are not known and need to be somehow predicted. That's the difference between, well, I need to put here bar, to maintain our notation. Yeah, now it's correct. Same logic of a computation, but some parameters are not known, some variables are not known. So it could be above or below the minimum acceptable rate of return. So now the question is, what is the favorable condition for an investor? How R hat S and RS must be related to each other in order to say that this investor is happy to purchase a stock. So, as I said, this variable can be above or below RS. Which one is favorable to investor? Come on, guys, turn on the brains. It's simple. You have a minimum acceptable rate and you have expected rate. How they should be related in order to say that this investor is happy with his investment or her investment.
The expected rate should be at least equal to the minimum acceptable rate or at least higher.
Of course. Investor buys a stock only if his expectation exceeds the minimum acceptable rate, or at least equal. Yes, if it's equal, it is exactly marginal investor, because this investor is indifferent. His expected rate of return is equal to the minimum rate of return, so he is indifferent between whether to buy this stock or to invest in something else. Now, actual rate of return. So actual is computed only after the fact of purchase and only after you decided to sell it. So if the market goes down, the actual return is going to be less than the expected return. This is what you need to keep in mind. And always, if I'm telling you something about rates of return, you must be aware what or which of these three rates of return I'm talking about and you are talking about, because these three are conceptually different things. Now, any of these two returns, expected rate of return or actual rate of return, can be decomposed into two parts. So one part is called the dividend yield. So for example, when you are taking expected dividend next year and divide this by the current stock price, P0, you get the expected dividend yield during the coming year. Well, we can basically compute the actual or realized dividend yield here for this, but look, those are different things. This is expected dividend yield when I divide expected dividend by the current stock price. Realized dividend yield is possible to compute because we have some historical data on the Fasagra stock. So we can compute dividend, let me write it like this, 2Q 2019 plus dividend 3Q 2019, and we can divide them by the price on 8th of October. Okay, so October 8th, 2019. Write down like this. So this is gonna be also dividend yield, but realized dividend yield. 54 plus 48 divided by 2525, and we have 54 plus 48 divided by 2525. We have 4.04%. Well, basically, this is your interest rate on this investment only due to the dividends. In half a year, you got something like 4%, so 8% for the year, which is not that bad, I guess. If you are not forced to sell this stock, of course. And the second part is the expected capital gains yield during the coming year. This is the difference between expected price next period and the current price divided by the current price. Again, this is expected capital gains. We can compute realized capital gains, return or yield. And what's that? We take prices. We take price here in the numerator. We take price on February 7th, 2020, sorry. Might be in the future minus this. The result is 2439 minus 2525 divided by 2525. So this is the realized capital gain yield, 2439 minus 2525 divided by 2525, minus 3.41%. And then once you add both this and this, you will get exactly the total realized return, this one. So what is the cornerstone of this discussion is that we always need to keep in mind what kind of return are we talking about. Is this required return, our requirement to the investment? Is this expected return, what we really expect to get from this investment? Or this is the actual return, so we are looking in the past and we are computing something from the past. Now, to the valuation of a stock. As I said, we are going to introduce a simple model of a stock valuation. We know how to value the bond. It's just the present value of a cash flow from this bond. Now, we can apply the same idea to this stock to get the following thing. So this is not a market price, this is the estimated price. The present value of a stock is the stream of dividends discounted accordingly, so it must be RS as well here. But look, this stream of dividends in principle is indefinitely long, so it goes to infinity. And this is the sum of discounted dividends from the next period to the infinity. Why to the infinity? We don't know when this cash flow will stop, will finish. That's why it is indefinitely long for us. And well, this is a generalized model for any pattern of DT. So for any type of dividends, you will get, well, for any pattern of dividends, for any size of dividends, you can apply this model. And the problematic question here is, what is the size of these dividends? We have seen how simple it is to build a cash flow for bonds. We just open the card for the bond on the Moscow Exchange internet website, and we are able to build all the cash flow, what to expect from this bond in the future. Now, the only data we have is the history of a company, so like this. And you see that, well, maybe people in the end of 2021, they build some expectations about future dividends based on this history. Now we see no dividends paid over 2022. At least if we see how company made their decisions regarding the dividend payments. Look, for example, for the first quarter 2020, they decided to pay dividends in June. For the second quarter in September, for the third quarter in November, for the fourth quarter in May. And we see that there is some pattern in these decisions. So the company does this as a routine. So the fourth quarter dividend, more or less, has been decided in May. Here, 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 here. Of course, if we see some repetitive pattern, we can make a prediction. But now what happens? First of all, we see that this pattern breaks with the third, well, not the third quarter dividends were also paid in January. Yeah, in January, even in February, and then they decided to pay it in December. But look, what we can expect next. Next, we can expect the decision to pay dividends for the fourth quarter in May. Nothing. For the first quarter in June. Nothing. And for the second quarter in September. Again, nothing, but there is still time. Maybe they will decide on it. We can hope. But in principle, well, we have no idea about it. So we can check, by the way, how this goes. Look, there was an extraordinary meeting of shareholders on September 2021. So let's see, maybe there was some decision about it. Look, agenda of the extraordinary general meeting, and we see that payment or declaration of dividends on the company's shares from the undistributed net profit and the procedure for payments. So item 1, payment of dividends on the company's shares from number of votes. So finally they decided on paying dividends. They decided on the payment of so the resolution to spend part of the company's undistributed net profit formed as of June with 780 rubles per each registered and certified share to determine 3rd October 2022 as a record date for persons eligible to receive dividends according to this resolution of payments. Wow, it's brilliant news. I haven't been following this. Payment of dividends to the nominal holder and the trustee, Okay, so finally they are going to pay dividends for this, and which means that basically the last dividend here must be updated. So now we can update that the last dividend is 780, right? So it's here. And this is the second quarter 2022. Decided or declared on, when was this meeting? 21st, September 21st, 2022. Okay. Which gives a hope that they will keep having the same pattern. Basically, maybe they also decided on dividends here, and we just don't see the full history. Let me see. Yeah, results. Look, on the annual shareholders meeting in June 30th, there was the item distribution of profits. Yeah, look, the voting on, so here was an interesting thing. Look, distribution of profits, including dividend payment. What was the question? So do we see an agenda, a list of information items? It's not here. Maybe this one. well. Okay, let's see. Where is an agenda? Agenda. Aha, here, recommendations, dividends. Look, to recommend to the annual general shareholders meeting should adopt the following resolution to approve distribution of the company's profit and losses, to spend part of the company's on distribution. So, what has happened on the 3rd of June 2022? Board of Directors guys, please mute your microphones while sitting on the lecture. The board has recommended to pay dividends, 390 rubles per share. But the shareholders, where is that? The shareholders voted against this decision. Look, 38 million votes for distribution of profits against 56.5 million votes against this decision. So shareholders decided that the economic, probably, I don't know what was the reason for this vote, but probably shareholders decided that economic conditions are not very nice to pay dividends. Okay, so in principle, we see that company sustains this pattern. The company sustains this pattern of paying dividends. 300, how much it was? 390 was the recommended dividend. Let's see on to the history of dividends for the company, and where was it? Here. And we can see that they somehow sustain this pattern of increasing dividends. So 105, 156, 234, then 390, and then in the for the second quarter they are paying. Oh my god, I forgot how much do they pay. They recommend to pay was something like, yeah, 780. So probably they somehow compensate the previous dividend plus the dividend for the next quarter. We can assume. Well, and this gives us the following idea. So what if we can simplify somehow this model? Because if we have a company that follows some pattern of dividend payments, why not to assume something about this? So, as I said, in practice, it is very difficult to forecast dividends. And that's why in many cases we can assume that the stream of dividends is expected to grow at a constant rate g. So there is just some rate how dividends are growing. And in this case, we can simplify the present value of a stock. Every dividend can be represented as a multiple of a current dividend and 1 plus g to the power of something. It must remind you from the second part of time value of money lecture a special type of a cash flow. This is a growing annuity, a growing perpetuity, perpetuity because it goes to infinity. So we can factor d0 out. In the summation we have this, and this sequence converges, so it has a finite sum if Rs is greater than G. We discussed this issue during time value of money topic. And we can simplify it to the following expression. It's simply d0 times 1 plus g divided by Rs minus g. So only when Rs is greater than g, we are able to evaluate this expression. Or expected dividend next period divided by Rs minus g. That's it. So now let me briefly show you an example of these calculations, or how we can apply this. So let's take dividend history for several periods of time for Fasagra. Where is their dividend history? Here. Oh, maybe it's better to use Excel. So let's take dividends from, I don't know, from 2016. And let's also impute what we do know about the previous periods. So we know that there is a fourth quarter, 4Q21, and one first Q22. Ah, wait, they are paying for the second quarter 22. So these dates are not that important for us, so we can at least somehow this is also not important, so we just want this. So this is a period and dividend. So in the second quarter, we know that they promised to pay something like 700. I forgot much. Uh, 780. Okay. We still missing this fourth quarter 2021, so let's do the same procedure. Let's see in the annual meetings of shareholders this data. Maybe we will be able to find an extraordinary meeting, 8th of December. Aha, you know what? Let's see, maybe there was a recommendation here. That was the recommendation for 2021. I just don't see whether they voted for dividends for the first quarter 2022, just, you know, to maintain this. Probably not. Okay. But after all, we can assume, let's also check another source of data. Rest. 134. Yeah, that's the last thing. Okay, which means that they were not paying anything here. And then look, just considering the size of dividends, we see that it is too huge. So probably this 780 is somehow split it, so it's a compensation for these two missing periods. So how we can compute the growth rate, or at least to get some idea about growth rate? So well, we can compute the growth rate for every period of time in this fashion up to the end. So look, sometimes it's increasing, sometimes it's decreasing, or maybe we can aggregate it by the year. So it's 2021, 2020, 2019, 2018, 2017, 2016. That's where art comes instead of some rule. We are looking for the most appropriate approach for forecasting the dividends of this company. So let's try this one. Let's try summing the dividends over the years to make probably something more reasonable. 17, 18 here, 19 here, 20 here, and 21 here. Okay, so for 22, we are not sure what is gonna be the next two payments. So that's why probably we can stop here, and we want a forecast for till the end of 22, right? So we do not know the full amount for the whole 2022 yet. What is the growth rate? So this is a dividend year growth. Now, if we compute it, we'll get something like this. So it's not that clear, right? Minus 50%. So here it was 137%. Here it's 50%. Here it's 60%. Again, there is no rule. We don't know how to evaluate this growth rate. It's just some kind of guess, expert opinion. It can be, of course, based on some reasoning, but after all, nobody would tell you that G equals something. You need to estimate it. Well, let's assume that the growth is gonna be, so looking at this 780, which is already almost double of this. Let us assume that the growth rate is, well, it's gonna be too huge. It's going to be, let's say, 15%. Of course, it's very small, but just, just to illustrate, I'm not going to deeply discuss these things. If you take 60%, we are gonna get into trouble because of this, because we want G to be less than RS. And the most, let's say, the required return is let's say 25%. This is reasonable required return for the stock market nowadays, for the Russian stock market nowadays. Of course, 15% is, well, if we are using G as the constant growth rate for a long period of time, you cannot expect that dividends are gonna grow every year by 50%. That's why I reduced this growth rate, expected growth rate, to 15%, right? Because you cannot expect that every year up until the end of the days, dividends are gonna grow with 50% or 60 even percent rate. It's not possible. So the company is growing now, but after some time the company will stabilize and the growth rate is gonna be more constant. So D0, we know that D0 is this for 2021, for the whole year of 2021. So D1 is what? D1 is D0 multiplied by 1 plus 15%, 0.15, something like this. We see that dividend is larger. But again, I'm talking about the expected thing that will be extending indefinitely to the future. We can adjust this model to the practical application later. So present value is simply D1 divided by 25% minus 15%. So this is the present value of Fosagra stock. And now we can go to the market and see what is the current market price. So let's take the current trading date, 7th of October, yesterday. And the market price, wait, no, it was for 7th. So October 2022, yesterday. So the closing price, you see that we assumed reasonable parameters because the closing price is exactly 5,829. So market price is 5,829 rubles, which is close to the estimated present value. But if you believe that the indefinite constant growth rate of dividends is going to be 15% and you require 25% from this stock, you will reject buying this stock at 5,829. Assume that the required return is 24%. The required return is 24%, then present value is going to be 6,000, and in this case you will decide, you will accept this price and you will buy the stock. Again, this is a simplest possible model. This model has practical applications in several places. When you have a really stable stock with a stable and predictable dividend growth rate. In practice, you see that this model is difficult to apply because companies are deciding to pay more, less. When they have an opportunity to pay more, they increase their dividends by a considerable amount. But still, the assumption here that this growth rate is kind of average over the whole life of this stock. So please don't take this model very seriously to make investment decisions, but rather take this model and think about this model as a nice guide to think what are the factors affecting a stock price. Now back to the question, or to the thing that Rodion said about Tesla. So now, why tweets of Elon Musk influence the market price of Tesla that much? Because of this. If he says something favorable about the future of a company, people immediately expect larger dividends, faster growth rate, and therefore the market price increases. They're ready to pay more. Once Elon Musk says something that potentially harms the profits of Tesla, the willingness to buy their cars, the expected dividends are decreasing. Probably the expectation of the growth rate are decreasing, and therefore the market price of Tesla goes down. So this model is a nice, simple model to illustrate what are the factors affecting stock prices. And just now I did it with the help of this model. So we need to conclude. So this model is called the constant growth model. Sometimes you can find another name of this model, the Gordon model, after the author, Myron Gordon. To conclude, the value of a stock as the value of a bond is the present value of cash flows expected in the future. Stock brings dividends for an indefinite period of time and or selling price in the future. Usually, we approximate this dividends cash flow with the constant growth model, sometimes with some other model. Why? Because it is really difficult to predict dividends for that indefinite period of time. Do you have any questions regarding stock valuation? As I mentioned, this is only the first step into that direction to give you some kind of feeling where are we going to. Well, if you don't have questions, then thanks for your attention. First group is free. Have a nice weekend. And with the second group, we meet for the exercise session in 15 minutes. Bye-bye, guys.
Thank you,